Hello, I'm Ellen Richstone, and I'm a board director of NACD New England. Thank you for joining us for our virtual program report from the 2023 World Economic Forum at Davos. Before we get started, we have a couple of housekeeping items. First, a reminder to remain muted throughout the program and to use the chat function to pose questions. No need to wait until the Q&A portion of the event to submit questions. We will monitor the chat box during the panel discussion and intersperse the questions as they come up. Next, we know that many of you want to receive credits for this program. To receive credit, we need to know your first and last name. Please make sure that your full name is visible on your Zoom window. If you are on this call via phone, send an email to Deb Rosenthal so that you receive credit. Finally, the panelists and moderators' statements and opinions are their own and not the companies with which they work. I would be remiss if I did not thank all of our chapter sponsors. The continued loyalty of these organizations underscores the important role of NACD. It is their support that allows us to fulfill our mission of delivering world-class, director-centric, local programming, and peer-to-peer sharing of insights that is vital to advancing excellence in the boardroom. Today, we are highlighting a very loyal sponsor who has continued to support us through these challenging times. Today's spotlight sponsor is Foley Lardner. Thank you for your support. Now, it is my pleasure to introduce Beth Boland. Beth is the chair of NACD New England and the chair of Securities Enforcement and Litigation Practice at Foley Lardner. Beth, over to you.
Good afternoon, everyone. We are so delighted to have so many folks join us. This is going to be a great program, and we have a great speaker here today. I am delighted to introduce you to Tamara Lundgren, who is the chair and CEO of Schnitzer Steel Industries, which is recognized by Corporate Knights as the most sustainable company in the world, and has also been recognized by Ethisphere as one of the world's most ethical companies for the last 9 years running. So very impressive credentials for the company. In addition to that, Tamara wears a couple of other hats. She is the former chair of the board of the U.S. Chamber of Commerce and also chairs the board of the San Francisco Federal Reserve Bank. So she is at the epicenter of everything, I have decided. And we are really, really honored to have her here today in my offices, but also with all of you on screen as well. So let's get started. One of the things that we wanted to highlight here was obviously Davos. So many topics, so many people, so many world leaders, both political and in business. I know I was riveted to the television with Fareed Zakaria, who is like my guru on all such things. But we have someone who was there, and not only there, but a very active participant, Tamara Lundgren, who is going to tell us about the lessons that she learned from being there, but also some of the behind the scenes takeaways that she pulled from the conference. So Tamara, I'll just kick it over to you.
Well, thank you, Beth. Thank you very much for inviting me. I'm really delighted to be here and delighted to see so many people on the screen. So Davos, it was January when it occurred, and life and geopolitical events have moved on quite a bit, but some of the themes that the conference was organized around are still very, very current and still very, very relevant. So the theme of Davos this year was cooperation in a fragmented world. And while the cooperation in an abstract sense was relevant, in a specific sense, it was really about increasing cooperation between governments and businesses to try to address some of the crises and challenges that were and continue to be in front of us, whether they're economic, climate, energy, food, a whole host of burgeoning challenges. It was the first winter meeting since the pandemic. There had been a summer meeting that was much smaller, so it had an energy to it, lowercase e, if you will, that came about because it hadn't been hosted for 3 years. And it was unusually warm, which was on a relative basis.
So that kind of cut,
right. Well,
it underscored the point.
Exactly. Well, it brought, it really brought to, on a real life basis, how Europe was able to navigate the energy crisis that they were experiencing because of the Russian invasion of Ukraine. And the Ukrainian situation reverberated throughout the conference and was part of almost every discussion. And it kind of spawned, I don't know whether it was an actual new word or it just became a word that was used a lot during the conference, which is polycrisis, which is, fundamentally defines related risks that have a compounding effect that end up being greater than the sum of the parts. So you've got the Russian invasion in Ukraine, which leads to an energy crisis, which leads to food crisis, which leads to increasing the global cost of living, which for many of the participants at Davos leads to a lower priority for carbon reduction, which then spins out into broader issues. So it was so the war in Ukraine really set the stage for a lot of discussions that went in different directions than I think would have happened had it been held a year or two before. The mood was mixed. It was, and I would say that most people say the mood at Davos doesn't necessarily end up correlating with what happens in the future, and I think we can see that today. There was pessimism about Ukraine and a perspective that the situation was not going to resolve itself in a short period of time or anytime soon. But there was optimism, and this, some of you, I think all of us will probably say, this optimism was probably not well placed in light of where we are today. But there was optimism about the global economy. Very few people were calling for a recession, even in Europe. They were calling for a mild contraction. Now, with what's been going on recently, it's not clear what the implications are going to be for a recession. I think the economists are there's a much higher probability for calling for a recession. But it was mixed of pessimism and optimism, but a recognition that solutions to energy, to inflation, to supply chain resilience, which was one of the areas that really came into focus over and over again, that solutions to those or progress against those challenges were really dependent on business and governments working together.
So among those, that panoply of topics, bring us home to how the Ukrainian war is affecting each of those topics in ways that perhaps, certainly a year ago wouldn't have been kind of looming on the radar, but not, very, very direct. But in terms of energy, in terms of the global economy, and now we see Xi Jinping meeting directly with Putin in Russia. Tell us how the Ukrainian war, the reverberations were being felt among the participants at Davos that we are now seeing even increasingly now.
So I think the first impact was very visual. Russia was not in attendance at Davos, and they had been a very big presence in prior years. And for an economy, I think they're the 11th largest economy in the world and a major energy producer, for them not to be in attendance, I think that's the first major impact that you saw. I think, as I said before, the outlook was one of no expectations that that people were going to be at the negotiating table anytime soon, and the impact on Europe was, very extreme. Obviously, in the energy, in the energy space. I mean, Europe has been for a very long time been focused on energy, but the switch to move away from energy dependence to energy independence, while trying to stay true to their focus on clean energy, is one that is just fraught with a lot of difficulties. And I'm sure you all read about it and have read about it. But they are still committed to, or they are committed to becoming energy independent, and over time to doing that on a clean energy basis, recognizing in the short term and probably medium term that the reliance on fossil fuels is going to be required to support them in their path to that end. I think as well, the impact on Europe with Ukraine has been the immigration issue. I think that they're experiencing an immigration crisis that they haven't experienced since World War II. So I think that has also been very tough. And then just the resiliency of supply chains. And I think we've all learned that lesson quite a bit. And I think that that is impacting how we all look at globalization and trends toward deglobalization, not necessarily decoupling from the rest of the world, but the importance of a more balanced risk management. I think that supply chains have been, or in the past, I think it came through very clearly in the pandemic, whether you're looking at pharmaceuticals or whether you're looking going forward at critical minerals, concentrating your supply chain in a place where things out of your control can really affect it, whether it's weather, whether it's labor, whether it's geopolitical events, that the focus on supply chain in terms of productivity and efficiency really needs to be balanced from a risk management perspective, so that you've got more national security and just much more of a more balanced risk profile. So I think that was a big takeaway in terms of how the Ukraine situation reverberated into a lot of other topics.
Wow. And we were talking earlier as we were thinking ahead to the topics for today about the impact of the Inflation Reduction Act.
Mm-hmm.
And it was interesting. I saw on some of our question notes that, one of the topics at Davos was IRA. And I said, I don't think that that's the Irish Republican Army. I think she's talking about the Inflation Reduction Act. But what is so interesting to me was how that in and of itself was such a hot topic and really kind of a third rail in many respects. So can you talk about that a little bit?
So that was probably the most interesting part of Davos from an American perspective, was the discussions, the impact, the perspectives around the IRA. And I don't think any prior Davos, I don't think at any prior Davos that there'd been a congressional action, a law in the United States that had garnered such strong reactions. Normally it's about policy or foreign affairs, but not about a domestic act of Congress. So fundamentally, Europe was not happy about the IRA. They saw it as industrial policy, and in their perspective, I think, was foreshadowed by Macron's visit when he came to the U.S. in late fall and met with President Biden. They are concerned about being cut out. I think that the fact that the IRA is based on tax incentives versus subsidies makes it much more user-friendly in terms of building businesses, developing businesses, moving businesses into the U.S. And so there were a couple of panels, one in particular that I remember, where Europe really viewed it as very protectionist. Having said that, they have now announced their own IRA called the Green Deal Industrial Plan and the Net Zero Industry Act. And fundamentally, my takeaway from all of this is that I think one of the most important developments over the last year has been this rise in what you might call strategic industrial competition among China, Europe, and the US to attract clean tech, to attract businesses that are focused on meeting the rising demand for clean reindustrialization. So that was a unique takeaway from Davos, which I think is still in place, where some of the activities, for example, between U.S. and China, while Secretary Yellen didn't attend Davos, she did meet with the Vice Premier of China in Switzerland, and they spoke about cooperating. They spoke about meeting. That was all pre-balloon. And things have things have moved on from there. But I think the impact of the IRA has accelerated some actions on the part of Europe, and I think all of that is good. We all need to be pushing forward with R&D development and working in a way where we can move clean tech around the globe and across countries, because as well as I do, air doesn't recognize borders and water doesn't recognize borders. So if any of this technology is really going to help the world, we all have to be part of it.
Okay, so that's a great segue for us to talk about your company.
Okay.
And, not just the fact that it is recognized as the world's most sustainable company, which is a really, really high bar. It's a very, very intense, I won't say competition, but the standards that the governing organization that bestows such recognition are very hard to meet. You've been working, and the company has been working on it for a long time. Tell us more about what your company does and how it has built on foundation year after year to reach that level of recognition, which I can only imagine has been a very long and iterative journey.
Well, I'm happy to do so, and I'm going to take maybe 60 seconds and talk a little bit about what our company does, and maybe inform some of you who don't know much about steel manufacturing or metals production, to give you a little bit of perspective. So I run a company that has been in the metals recycling business for 117 years. And what most people don't know is that metal, and I'll use steel as an example, steel is the most recycled commodity in the world. There's more steel recycled than glass, paper, wood, and plastic combined every year. 70% of the steel made in the US is made using recycled metal, which means that the metal in your car, if it was made in the US, or the metal in your washing machine, or the rebar that you see in all of the buildings going up in and around Boston, that all came from some other product. And excluding China, about 50% of the steel made in the world is made with recycled metal. So you either melt down metal, which can be melt down infinitely, or you mine iron ore. So the world is moving to increasing the amount of recycling that is done. And unlike paper, which ultimately dissipates, steel can be, or metal can be melted down over and over again. And the importance of metal in the rise of civilization cannot be underestimated. Copper was discovered 10,000 years ago. And you can track the rise of civilization with the use of metal. And if you just think about your day-to-day lives, whether you're in your car, on your bicycle, using your phone, you are interacting with steel, with copper, with aluminum, and with lithium, and all
some
other
of
metals.
which may have come from your recycling plants.
Right, exactly. So what I say to people about our company and to new recruits and the like is, we have been about sustainability before sustainability was a word.
Was cool.
Yeah, exactly. And before
you
it
were
was
there
cool.
before it was cool.
That's right. And so adopting, going on our sustainability journey, and is something that is at the core of what we do. Now, was it addressed as sustainability or a framework of our framework is based on people, planet, and profit 100 years ago? Absolutely not.
Right.
But any company who's been around for 100 years, by definition, has been a sustainable company. You know, we've all focused in different ways on our people. We've all focused on our communities. I mean, think about company towns back in the 40s and 50s. In Iowa, Pella, for example. In Michigan, Dow Chemical, which is in Midland, Michigan. Kohler in Wisconsin. I mean, these are all examples of companies who have focused on people, on their communities, on all their stakeholders, including profitability, in order to be who they are today. So I think that we're now just more focused. I think the capital markets, the Business Roundtable, and many other organizations are focused on awareness. I know that when we started our journey, we're a public company, it was really driven by European investors. I would go to Europe to do non-deal roadshows, speak to our investors there, and they would ask me, this was starting over a decade ago, can you please issue a sustainability report? And the years that they were asking me, it was right after the global financial crisis, and I'm in a commodity-based business. So for those of you who have exposure to that, we have great ups, we have great downs, but you know, you've got a commodity cycle that you've got to be cognizant of. And I remember saying to them, it's just really not where I can apply resources right now. And their view was we need you for the European investor base. We need you to show that you are aware of the other stakeholders fundamentally. They didn't tell me what we needed to report. They didn't tell me what our goals needed to be, but they wanted that awareness. And I think that is so much a factor to this, because as I said, you all are on boards, probably many of them are companies that are decades old. For them to be around for decades or centuries, they have at their core been about stakeholder capitalism. That may be a new phrase, but it's not really a new activity, because they wouldn't have survived if they hadn't balanced focusing on people or employees, on suppliers, on customers, on profits, and on community. So that's kind of the core of our journey. And we started when we started this formally about 10 years ago. We did create this framework of people, planet, and profit. And I did identify a chief sustainability officer. And probably one of the most important things I did for our company, which is largely manufacturing, there are only about 3 to 4% of my workforce are office workers. I pulled the person out of operations as opposed to out of a corporate function, because I didn't want it perceived by the bulk of my employees as being corporate speak or something that wasn't important. So because, as I said, what we do and how we do it are very intertwined with sustainability, it wasn't a hard leap, but the leadership was very important. So
and you elevated somebody from internally, didn't bring in some hotshot from the outside.
Correct. I elevated someone internally, and for the first few years, it was he split his time. We eliminated some of his operational responsibilities. He kept some operational responsibilities, and then took on the CSO role. About I want to say 2 to 3 years ago, it turned into a full-time role because the reporting just became much more extensive. The work became much more extensive. The external communications became much more extensive. So it became a full-time. It became a full-time job. And I pulled somebody out of our innovation group to run it. So I think it's important to think about that in identifying a CSO so that they are able to communicate so it's not just coming at the top of the organization.
The edict from above.
That's right. But that it's really embedded. And we did a materiality assessment, and that was very important. And I think most companies do that now. And that helps set the priorities of what is important to your stakeholders, which can be customers, suppliers, employees, investors, and you survey them. And then you're able to consolidate that feedback and determine your own priorities. So that was important to us as well.
Right. And as I'm listening to you, and for those of you who may not have kind of pictured it in your minds, right near the Wynn Casino is where Schnitzer Steel has a very big facility. And those of you who may have driven by it would just look at it and say, oh, it's a big recycling plant, and there's noise, there's whatever coming there. What you don't realize is the technology and the sustainability focus that goes into what from the outside, you know, looks like these big grinding machines, but there is a great deal of thought going into how they operate, what the throughput is, and then how it's utilized. And then you have the whole corporate infrastructure of the idea of sustainability. Now, I am willing to bet that you probably got some pushback internally, maybe externally, on your efforts. Tell us about some of those hurdles that you encountered, and then how you met those, and what advice you can give to our audience, especially from the board level, about what they should be looking out for and how they can really encourage and support their CEO in that sustainability effort.
Absolutely. So we do community tours from time to time if any of you are interested. But what our operation does in Everett,
sign up.
What our operation does in Everett, I'll give you an example. We acquire end of life vehicles. So these are cars that have reached their end of life for whatever reason, either an accident or their end of life. And after extracting the hazardous materials from them, we crush them. And that flattened car can go through our shredder in 10 seconds. And the output are fist-sized pieces of metal, my size fist. And from that, we apply various technologies to separate the ferrous metal, the steel, from the non-ferrous metal, like the copper and aluminum, for example. And we separate that, and then the other products, whether glass, plastics, foam, dirt, the like. And those metal products are either put in containers or bulk. The non-ferrous, the copper and aluminum, we typically put in containers. The ferrous, we will bulk load onto a ship that docks right at our port, and that is then exported to steel mills and copper smelters or aluminum smelters around the world, or domestically in the U.S. So that is an example of cradle to grave to cradle. I mean, that is truly circular, because that material gets melted down again and appears in another product. So that's if any of you are ever interested in a community tour, reach out and I'll make sure that you can come and visit. But in terms of pushback, external or internal, on our sustainability journey, I will say externally, the biggest challenge is the myriad of reporting requirements. I mean, if you pick up, and I'm sure you all have seen your own company, the boards that you sit on, or the company boards, the sustainability report, the documentation in the back of the report is typically just as long as the front part of the report that describes what the company's goals and achievement against metrics are, and that's not particularly efficient. Layer on top of that the evolving feedback from the SEC in terms of the reporting standards that it wants to deploy, and you are beginning to have so much that it's going to crack the back of what people are trying to do. So, I really do think that over time, we need to merge a lot of this, just like we do with financial standards. You've got IFRS,
GAAP,
or you've got
right,
GAAP, and
right.
You've got a couple, and you can apply which one is relevant to you, but you don't have the myriad of reporting requirements. Now,
really dozens,
and it has fostered a whole cottage industry every type of company. There were actually a lot at Davos who are developing software so that you can track reporting and again, if you want to, in many companies do want to track everything in their supply chain. So what comes through and what goes out, whether they're manufacturing, whether they're producing, whether they're in the retail space. So those reporting frameworks are important. The software systems to support it are important, but you don't want to end up with kind of a Rube Goldberg kind of contraption that then becomes so difficult for your people to manage that the cost benefit then becomes under stress when you go into recessions or downturns or the like. So that's what I would tell you is the biggest external issue. As I said, we were prompted by investors first and foremost to do this, and from Europe.
That's interesting that Europe. It was really from the shareholder base, the institutional shareholder base.
And now it's fundamentally table stakes for any public company. Right. Internally, there really wasn't a push. I talked earlier about the intentional selection of the first leader that we made, but I would tell you that one of the reasons why I don't think that there was internal pushback is that I think employees and the younger, the more relevant this is, they've moved from the question of what do you do, which was kind of the question we always asked when we were in our 20s and 30s, to each other, to why do you do what you do? Mm-hmm. I think that what to why is really probably a less articulate way of talking about purpose and sustainability. But from the employee perspective, so many of them come to us because it answers their why. Why am I working? I am working because this is helping. Because every day is Earth Day at Schnitzer Steel. So we didn't get pushback internally.
Oh, that's interesting. Yeah. Now, what about the role of the board? I don't know whether this was more, it sounded like, a little bit more organic, and especially driven by external shareholder questions initially. But at some point, you really needed the board there and the board behind you. How did you approach that, and what support, and how did you utilize the support from the board to be able to continue that path?
Well, our first sustainability reports were really focused on a lot of community work that we did, a lot of explaining the environmental impact of what we did. It was more descriptive, and that resonated. That resonated and was understood by the board in terms of a communication piece. But as we moved to setting goals and setting metrics, the board was very engaged in that, because some of the goals require capital investment. Yeah. So you can't set out, particularly some of the environmental goals, you can't set them out if you don't have a capital plan behind it. So there was a natural interaction. And I think that the overall, as I said, issuing sustainability reports now is table stakes, I think, for public companies. So I think that was just a very natural evolution. But one of the questions that has come up at our company has been, well, what committee, investors or various people say, well, what committee at the board level focuses on sustainability? So we don't have a separate sustainability committee because it is what we do. Mm-hmm. That's probably not going to be the case as it relates to a services firm, an accounting firm, or a software firm, or there are other businesses where it is not so intrinsic to their purpose as it is to ours. So we don't have a separate sustainability committee. It is our goal setting and our metrics. And our performance against that is set by the board.
So speaking of sustainability,
or overseen by the board, sorry,
yeah,
what I should say.
And that gives us a segue to the whole ESG issue. And as those of you who participate in many of our NACD programs, you know that sometimes we have standalone programs on ESG, but it is infused in virtually every single program that we do. But now we are starting to see what seemed to be such an innocuous, type of motherhood and apple pie type of issue has now become far more controversial. Can you talk about, that whether it has impacted your approach, and if so, how, or if not, then why not? So talk about how to position the world's most sustainable company in an atmosphere where that is, now less universally recognized or lauded as it was even a year or two ago.
Okay, so I think it is probably worthwhile to unpack a little bit about how things have evolved. I think in our company, we're not getting pushback. I don't expect any pushback because of what we do and how we apply sustainability to what we do, how we measure our environmental impact, and just the nature of our business. But where I think that it is trickier is in financial services, and in particular in investing. So whether it's retirement plans and kind of asset management, pension funds, that's where I think the controversy really began with respect to trying to starve fossil fuels companies and invest in startups and risk returns in that transition. So that's where I think the issue started. And then, as you know, what happens with so many things, they devolve into sound bites, and they devolve into kind of a peanut butter approach. And so I think as a result, ESG now is a word that a lot of people aren't comfortable using. So the word that I see a lot of people using now is impact. These are just words. At the end of the day, I go back to what I said at the beginning, which is sustainability is core to what any successful company has pursued for decades or centuries. A focus on doing the right thing, operating with integrity, operating safely, operating with a focus on your employees, on your customers, on your communities, and on profitability. You can't do all that focus and also not make money. So making money is not a bad thing, because if you don't, you can't pay your employees and invest in the community and do all of those other things. So from my perspective, it's a virtuous circle. And I think, when I talk to other CEOs, I get the same feedback. No, we're not going to stop doing what we're doing. Name calling and sound bites isn't helpful in defining what we're doing. And but you kind of focus on your North Star. You focus on the things that where there's a commonality, and then you try and navigate where there isn't. And it's one of the issues I think that's going to be a challenge with respect to SEC reporting. It doesn't, the trying to create one reporting framework for companies for whom environmental impact is very different.
Yeah, very different professional services versus your company.
I think that rushing to develop reporting standards it can be may end up lowest common denominator and ultimately meaning nothing, and then replacing the sustainability reports, which are actually very informative about a company's priorities, what their goals are, and how they're doing about that, what they care about, their culture, all those things that are just much more difficult to put into an SEC document, and just much easier to put into a communications document where we can each we can each articulate it in the way that is relevant and impactful to us. So I do worry about that.
Yeah, and it's interesting because some of us on this call were at the NACD summit, the big national NACD conference back in September, October of this year. And there were a number of panels, especially in the audit committee kind of segment, obviously addressing the proposed new SEC reporting requirements. And those sessions were packed. Mm-hmm. And coming away from participating in those and then coming away, the biggest takeaway, especially given the myriad of reporting frameworks, which I think is just the biggest, gating hurdle, is to think about if you're a company with, less than $1 billion market cap, or even less than 500 million for sure, how do you get the reporting infrastructure to create those foundational stepping stones so that you can have the reporting framework that the SEC is looking for? And I think that's just, they need to figure that out first before, for many, many months we heard the SEC standards are going, or the proposed rule is going to come out. And I think they wisely have not done that until we can hammer out more clearly what those reporting frameworks around what the final disclosure will be. So, okay, so we've talked a lot. And Ellen, do we have any questions in the chat?
There are a couple questions. Let me pose two to you. One is from Stephen, who asked Tamara to talk about how your company strikes the balance between all your stakeholders in making sustainability a profitable endeavor. And the second one was asking Tamara to share with us, and this is from Catherine, how you educated the board on the company's sustainability journey, including establishing priorities and metrics. And then I would expand that and say, can we talk more about what metrics you found the most useful? Because at least in the boards I'm familiar with, the big thing we're struggling with is, what metrics do you really use, and then which ones do you disclose? So I'll leave you with those thoughts.
Right. All right. So I'm going to start with the first one in terms of how do you make this profitable? So I go back to sustainability is how you run a successful business. If you don't focus on your employees, balance their career advancement with their compensation, with their benefits, you're not going to be able to recruit and retain. And similarly, while any capital intensive company always gets more requests for capital spend from their operations than what they actually spend, and you've got to prioritize it against your strategic initiatives and which ones need to have priority or have the most impact. Similarly with M&A and the like, it's all a balance. Running a company, just like running any type of community, is a balance of competing priorities. And what board members and CEOs are responsible for is establishing those priorities and executing against those priorities. So we all spend money that doesn't generate a direct return, but we think that the spending of that money moves us forward in a different way. We also spend money in a way that we make sure generates that return, that return in excess of our cost of capital, to be top in our sector, top in our industry. So if ESG or sustainability had never been created, we still would be making these same decisions. So it's kind of like, I remember when we went through a safety overhaul at our company. And one of the things that I said is we need to move away from someone thinking about, well, this is the way I do my job according to the safety rules, to there's only one way to do your job. There's only a safe way. There's not this way and then, oh, right, that's the safe way. There's only one way. And I feel that same thing about leading a company pursuant to a sustainability framework. There's only you've got to balance the priorities, and they will change over time. I mean, you can see what all companies have been faced with in terms of the high inflation environment, the shrinking or the smaller workforce that we've developed, and the high demand is compensation has increased significantly. Had it been lagging before? Should it have been increased before? I mean, that depends on industry, and it's sort of not the question at hand today. The issue is where are expenses focused right now, because people are short workers, and that's where it's focused right now. In another period of time, that's probably not going to be the biggest trajectory of expense. So I think it's a journey. I think it's an evolution, and I think that's what being a board member, being a CEO is all about, which is navigating through the environment that you're operating in. In terms of the question regarding what metrics, that's where I go back and say a materiality assessment is really important for every company to do. I think if you are trying to identify the right set of goals and metrics for you in this space, because that's where you're drawing input. This is non-binding input. It's not a vote, but you're doing a proactive reach out to find out what is important to your various stakeholders. And many of your companies may be doing this generally through employee engagement surveys, through customer surveys, through government relations work. So you may be getting this information in a different format, which is perfectly fine. But I think from there, you figure out what your metrics are. So our greenhouse gas emissions reduction, because we have heavy equipment and mobile equipment and the like, is very relevant to us. I doubt it would be relevant in the same intensity or same proportion if I were running a professional services firm. So I think that you've got to figure out what's so I think you've got to figure out what your priorities are and what your stakeholders are identifying as needs, and then prioritize them accordingly. We do a materiality assessment once every 3 years, and that helps us calibrate.
So I think we have time for one, maybe two last questions. Ellen.
All right.
Anything else in the queue?
Yep. There's an interesting question from Glenn, which says, can you give us your thoughts on the issue of greenwashing in the vacuum of clear ESG reporting standards?
Yeah. So that's a really good question. And you can argue that some things that people do I am offsetting my carbon by doing X, Y, or Z may not really be doing much. I think it's a good question, but I think that's where you again get to this peanut butter approach. Because
okay, I have to ask you, what's the peanut butter?
Peanut butter is just, you put peanut butter on a piece of bread, just flat. I mean, you don't put a little bit more in the corner and a little bit less in the middle. So you're just, you try and
smooth it out.
Okay. So that's where I think that leads to greenwashing, is trying to get everybody to give an answer to the same question when it's not relevant. And that's, that is what I worry about in terms of certain reporting frameworks, is that you force people to respond to the same question when the impact, the impact is not the same. And so I think it's an excellent question. I think it's an excellent question.
Right. Any others, or should I take my prerogative as moderator to, okay. So given that we have a little bit of time, I have to ask you, I mean, you are sitting at the most interesting perch, which is chair of the board of the San Francisco Fed. And I know that each of the specific feds, whether it's Boston Fed that our president, Kathy Minahan, used to lead, or each of the regional feds are more execution, not policy formulating entities. But nonetheless, it's a really interesting time in the industry, and in particular on the West Coast. What can you tell us about the trends that you see? Should we be hiding our cash under mattresses?
So first of all, I'm not giving any financial advice. That is
right.
not. You can talk to me about how you make steel, and I'll talk to you about that, or how you recycle metal. I'll talk to you about. I'm not giving any financial advice. But I'd say a couple of things. Supervision of banks is centralized at the Board of Governors at the Federal Reserve in Washington, D.C. That's a very important principle, because banks need to be treated, obviously different categories, but if you're in the same category, consistent treatment across the country is really important. You don't want banks from the Richmond Fed being dealt with differently than the Dallas Fed, than the San Francisco Fed. So I think that your comment about it's different on the West Coast, actually, it isn't different on the West Coast. It's not. So regional bank boards of directors do not have any supervisory responsibility or accountability. In fact, legally, we are not allowed to have any access to supervision information or supervisory information.
I mean, the exam reports and so on.
Correct. That's not part of the remit. And if Kathy's on this, I don't know if we can give people a mic or not, but Kathy, you may even be able to speak to this more specifically than I can. But board members of all of the regional Fed bank boards are chosen for their ability to bring to their regional Fed their perspectives on the economy, what the impact is of the industry that they're representing or associated with on the economy, and to help discuss and inform the Fed or of the effects of what is going on their business, and help inform what is happening in their particular district. So I think that when crises happen, the level of research that's needed for complex reporting may not be done, and so again, you end up with sound bites and perspectives that don't reflect what by statute is required. By statute, the Federal Reserve bank boards have to have three representatives from banks. Now, they are not involved, for example, in succession planning and choosing the president of the Fed for obvious conflict reasons. But there are statutory.
Right, they would have a keen interest in that one.
So there are statutes that require that outline very specifically who must be on the board, how they're selected, and then very clearly, what the responsibilities are. Having said that, I think over time the reporting is getting clearer than it was, and obviously people want answers right away. And there's a review underway that will be, the results of which will be out in May, that will address both whether policy should be different, whether execution should have been different. But we will all need to wait. We will all need to wait for that report.
Right. And I should also mention too that one of our board members, Corey Thomas, who is the CEO of Rapid7, I believe that I read that he is now chair of the board of the Boston Fed. He was on
Yes,
the
he is.
board, and
Yes.
now he's the new
Yes.
chair.
Yes.
Among his 20 different hats
Yes.
that he wears as well. So Ellen, anything else we should address before I turn it back to you? Okay.
Nope, Beth, I think we're ready to go to close. So
Okay.
let me just say thank you, Beth and Tamara. I have a few quick announcements. Tamara, apologies. Thank you, Beth and Tamara. I have a few quick announcements before we end. Our winter spring program calendar is full. I hope you will join us at one of our upcoming sessions. On March 30th, we will virtually host the Future of the American Board with the Minnesota chapter. On April 6th, we have a virtual program on stakeholder activism and capitalism. We have two day-long programs, which we hope you will take advantage of. The first is the Aspiring Public Company Director Program. It's a full-day session in person, scheduled for April 20th. This is going to be in person in Boston. It's perfect for executives who are looking to join their first public board. Then on June 15th, we have our Experienced Public Company Director Program. The only attendees are sitting public company directors, again in person. And this is the advanced topics in corporate governance for sitting public company directors. Hopefully you will join us for one or more of these programs. Finally, don't forget the survey. The link is in the chat and it will be in our follow-up email. Please take a moment to fill it out now. Thank you to everyone for attending, and thank you again to our speakers.
Thank you, Tamara.
Thank you.
We look forward to seeing you at our next event.